Now, when we go to segment 3, we wanted to look at some key capacity on the U.S. consumer. So we talked about the U.S. consumer in general from inflation, but what is going to happen on the consumer sentiment? And obviously that's gotten a lot better. And we want to look at, okay, well, we went through some of the negatives. Now let's start looking at some of the positives that we continue to see. But before we get there, we just wanted to talk about will the rent of shelter reconnect to reality alongside a reopening of the economy? So here you have the COVID-19 breakdown of the CPI rent of shelter, but the model that they're using for inflation expectations, vacancy rates, house prices, landlord asking rent is shifting to essentially an all-time high, or at least going back to 1998. So we saw this big spike in 14 through 16, but instead it was more of a stable move higher in the rent side. But eventually we're going to get this pivot back, and this is where you'll start to see that acceleration. And this is something that we've been talking about as being very much under calculated, or at least not appreciated to the levels it should be. So then when we look at the conference board, consumer confidence, obviously consumer confidence, it moved back to a recent high, going back to obviously the beginning of COVID, which is a benefit in general. So consumer confidence is up, consumer expectations is starting to get better. And present conditions is people are feeling pretty good. They just got stimulus. They're getting their vaccination. They're feeling better about where this is going in general, which is, again, that net positive, which is driving some of this market sentiment and some of these views. But it's important to weigh this with the confidence now versus the confidence going forward. So then when we start looking at, okay, well, what is the present situation? Well, the present situation is getting better, and then expectations are also improving. So the expectations is the one that we want to continue to look at. And I think that there is a view that we're going to get an increase in wage inflation as well to try to offset some of this current inflation. And that is what is being baked into the market. This is going to be the one to watch when we're looking at expectations, because we're back to some recent highs, and you can see that we got to the high, and then things pulled back once we got some of the negative data points. And I think it's going to be an interesting point to understand where do we sit right now, and what does this mean going forward. So then when we look at the demand for housing, so expectations are also getting a little bit better. So now the demand for housing still remains robust. So consumer confidence surged to its highest level in a year, according to the conference board, with both current conditions at 110, expectations at 109.6, rising 20 points. The labor differential improved to 7.8, which is also its highest since last March, but only marginally better above October levels. So again, employment remains a problem. The labor differential remains the overall problem. But the most dramatic thing was the increase by 8.4% of respondents planning to buy a home in the next 6 months. So even though we have pricing where it is, everybody's trying to lock in these great rates, and we still have more people looking to purchase homes. So this is where we get this bifurcation of, well, the labor differential is better, but not great, but yet people are still feeling really good about where this is going. And I think we need to see some of that labor tail off a bit more before we see some of those expectations normalize. But when we look at the purchase-only house price, so we're looking at housing prices, which are surging to the upside while earnings do nothing. So this is where we can, that separation of wage inflation versus actual inflation arises. When you look at just how far your money goes, you're just not getting. Not to say that you have to marry perfectly, because you don't. There can be some of that bifurcation. But you can see what happened in 2008 when we got too far ahead, and then you had that pullback, and now we're just going parabolic when you just look at the rate of change of that line, which is why, again, either wages are going to have to go up, or we're going to have to start to see some of that rollover with that pricing. But, well, what is that pricing made up of? Well, when we look at the 12-month price changes, prior year versus most recent year, you have price change, and then from 2019. And then when you look at what has happened so far through 2021, we're seeing a big increase in just total activity across the board, which again is coming into the US, which is coming into the Pacific Mountain. There is not a single place that isn't seeing an increase in total activity, which again is just pushing that all the way through in general. So then when we look at it on a longer time frame, so this is one when we look at the 20 case that comes through the different CASE-SHILLER pricing. So when we look at Phoenix, Seattle, San Diego, so we're looking at just main places. Some of these places should have seen price discounts, especially with rent, people moving from urban to suburban. But we continue to see this increase in general when we're looking at the 1-year average. And when you look at just all-time high date, most of these were January 31st of 2021. And this is where, again, looking at the disconnect with where is this inflation number coming from, because this is going to see prices. Now, given there is a discount because mortgages are cheap, allowing you to buy more, but this is where we're going to have to see how quickly do property taxes go up. What is the rise in the 30-year really do for pricing? And that's going to be, I think, a bigger concern over the coming few months. So, but when we look at U.S. private equity investors, they're trying to sop up this spare real estate. So even though we've seen this decline in commercial real estate, industrial real estate, there's more than enough private equity investors that are looking to pick up these real estate debt funds. And this is why we when we were creating our own private equity fund, everybody we talked to were trying to pitch and raise money for these funds. And it just seemed crowded. And now when you look at the data overall, you can see just the level amount of money that's chasing this, which is just going to compress returns. Hint, hint, wink, wink. We have a private equity fund if you're interested. So when we look at just what is happening here, you can just see the inherent pressure that continues to come, and which is why there is some support for where this pricing is, and it's hurting just overall returns. So when we look at commercial property prices, you can see the pretty steady recovery. Obviously, retail remains under pressure, but apartments, industrial, office has started to see some price improvements as the competition mounts, because people know that this is going to be a certain amount of temporary. We talk about in the EIA show how the flex schedule is going to become a bigger part, but flex schedule still means you have to go somewhere. So again, these are things that we're continuing to see come through, and this is why some of the pricing is going to be supportive. But when we look at the debt servicing, so when you think about those prices on homes, you have to think about, well, what is the debt servicing? And it's still extremely low, as we've been talking about, but it's bouncing off those lows. So here you can see just the 30-year mortgage rate has bounced, really pulling up that mortgage debt service ratio. And as this continues to climb, that's when you're going to start to see some of these home prices have to come down, because people just won't be able to afford it at the same level. Now, when we look at CASE-SHILLER, looking at it on a monthly versus year-over-year change, you can see that just, I laugh at the numbers because they're so absurd. But when you look at from 2003 to 2021, we've had a 76% increase of February 12, 2012 to today. And then when you look at the year-over-year change, again, we have that 12% increase, which is the highs that we reached at the two different peaks in terms of just when some of these bubbles are. Which is why, again, we remain concerned on where the future looks on this going forward. Then when we look at what does the competition look like? And this is just showing you, I thought it was an interesting chart, that 4 offers are received per sold property. So for every property hitting the market, there are 4 offers coming in to chase it, which is, again, driving up that cost. So then when we look at the shortage, so this is why another reason why we continue to see a lot of the support in there is because the current new and existing homes for sale at the end of the month, on terms of just an inventory level, we're near an all-time low, or no, we're at an all-time low based on what we're showing here, but we're near an all-time low when we go out through history. And then the estimate of required homes for sale equivalent to 6 months supply. So you can see that delta is massive, and that's, again, driving up the bid on a lot of these different homes. But what is the employer doing? What is the employer doing? What are the employees seeing? So the change in employees working has increased when you look at hospitality and entertainment, which again is what we think is going to be the biggest driver of this recovery. And then when we look at the employment in the restaurant sector is likely to recover further in March. This is just looking at the seated diners. So as the seated diners come up, you're going to get that push in the amount of employment that we're seeing in the food, service, and beverage space. And Indeed.com is supporting that. We continue to see new job postings. We're now back above where we were at the beginning of February. Again, a net positive for the amount of people that can get jobs, but there's still a lot of competition out there. Now, looking at it a little bit differently, we're going to look at unemployment rate adjusted for labor force outflows. So labor force outflows, misclassification, you're seeing that, again, there's what is actually reported, and then there's that miscalculation or just people that are never coming back as their labor force outflow, which is putting us well over 10% that remains unemployed in the market, which is why we look at the different percentages with 11.6 in the different capacity. And this is why we continue to look at what is that labor situation really getting at. And then not in the workforce due to retirement. You can see that COVID has forced more people into retirement, which if you're young, trying to get a job, some of the older individuals leaving allows for some upward momentum. But when you look at the labor force participation rate, 55 years and older, it's not just people retiring. You're getting a big, I guess you're getting this big drop in general. And the question is how many of those individuals will come back? And if you start looking at just cost, if you want to hire a cheaper person, who's going to be cheaper? Someone who's 55 or 35? And, you're going to lose on a certain amount of experience. But again, money is going to matter, especially when you look at prices paid versus prices received. Companies are going to want to try to reduce their costs as much as possible, putting more pressure on those numbers. So, but you're still getting that move in mobility, which we talk about in segment 1, in the EIA segment 2, but we're going to talk about it here a little bit differently because when we look at retail and recreation, that is pulling more people back into their jobs, which is going to be that net positive move, while transit stations seeing more growth, but workplace, grocery, those still continue to be fairly flattish, which is, again, capping some of the growth. So the retail and recreation will continue to be some of the benefits that we see in new additions. And this is just showing you where we sit, where, unemployment claims still remain elevated. The regular benefits continue to go down, but everybody's just getting put back onto pandemic extended benefits, which you can see has been holding anywhere between 18 to 21 million over the last, essentially since the pandemic began, which is where we continue to see this overhang when you're looking at the jobs market in general. And then when we look at the U.S. goods trade balance, this shifts a bit into, well, this is where we continue to see pressure on pricing. The trade balance continues to be under pressure while these individuals are trying to get things, trying to raise prices. This is one of those key things in terms of raising prices. But when we look at what are Americans getting more concerned about? They're getting concerned about energy availability and affordability. So when you look at the infrastructure fund is meant to look at this, but again, as we've been saying, it's a basket approach. It is a coal, nuke, wind, solar, geothermal, and hydroelectric dam, as well as just everything needs to be used to bring down the cost and increase the efficacy and just the resiliency of it, because as people are facing down the barrel of inflation, they need to make sure that their energy is affordable. And this is where you start to see some of these risks. I mean, given there was a big event, people always get concerned over a big event, but there was concern before that. I mean, you're talking about 54% and now 73%. This is going to become a growing issue over the next few years. And then majority believes U.S. will face another critical energy shortage, is rising from 32% to 53%. Obviously, Texas had a lot to do with that. But you also have a lot of headwinds when you're looking at, well, how do we address this? What is the proper way to do it to make sure that there's redundancy in the system? Because you can't, some people can't afford to have a plumber come in and spend $3,000 on a cracked pipe. There's a lot of benefits to having that sustainability and affordability really baked into your underlying costs. And then changes in worry when you're looking at just the affordability in general. You can see that all adults in general, and this is a very bipartisan issue. So the bipartisan issue is hitting from a Republicans, Democrats. So this is not a just Democrats want green, Republicans just don't just want to use carbon. This is a bipartisan issue that needs a bipartisan solution. And it's time to get serious about, well, how are we going to power our grid for the next 20 years and create redundancy as we're taking base load off and have to replace it with peakers and other types of means that have some sustainability on a green level, but also sustainability of we still need power and we still need reliable power, especially if we're going to attract more corporations and we want to increase our manufacturing capacity and our GDP growth. We're going to need a lot of power that isn't going to go off anytime soon and at the same time is affordable. So then when we look at restaurant, diners, and payrolls, this is, again, where we keep talking about the amount of people coming back. It's just they're not high-paying jobs. So we're going to get some of these job additions, but it'll come down to how quickly do we see this really pushing down into the spending side of or the consumer side of some of these increases. And now rates volatility is higher with steeper yield curves. So this is where we continue to see these yields going up. As inflation comes concern, we talked about the infrastructure. So clearly people care. They're going to want the infrastructure bill, but at what cost? And this is where we continue to see this volatility going up. When we look at the MOVE index, the VIX, this is going to be a big driver over the next few months. So then when we look at the consumer spending, you can see just where people didn't spend. And it was recreational goods, it was vehicles, things that people have already purchased. And they purchase in size because they were home, they wanted to do stuff. Some of those things only have to be purchased once or twice. And that's where we're going to start to see some of these slowdowns. And not only are we going to see slowdowns because people already have it, but now you're going to also see prices going up, which again is going to kind of cap where we're seeing some of the spending. And to put it into context once more, in a different way, when you look at new orders, so new orders are going up, backlog of work is going up, all of which point to future growth, but the backlog is also because you're struggling to fill current orders. So this is also creating some latency or in the system that has to be made up. And then when we look at, output prices, delivery times is making that very difficult. So when we look at output prices, delivery times, these moving in the wrong direction is just increasing the pain or the stretch within the supply chain, which is just, again, driving up those prices, which is why when we look at input prices continuing to surge higher and then prices charged continuing to trend up, the input prices will keep those prices charged just trending and just pulling them into the stratosphere. And then that's when we look at, the different backdrops. What is driving that? Well, the prices paid for raw materials. And then the prices received for finished goods. So the raw materials going up is, again, pulling up those finished goods. And this is looking at Dallas, as we said in segment 2, with the different backdrops, it's not just in one area, it's across the US. And this is just another one. When we look at the manufacturing index and new orders, the new orders are going to be supportive. It's just at what price will these new orders be sold at, which is going to increase that underlying inflation. And obviously, gasoline prices continue to push up. We talk about it in the EIA segment 2. There's been some normalization, which we're seeing here as crude prices kind of normalize a bit and pare back. But there's going to be that back and forth until we can start to see some of this normalization kind of filter through. But regardless, you can see as we go back through 2019, 2018, 2020, we are at a very high period ahead of summer driving. So it's only going to get worse as we go into summer driving, again, keeping the pressure on the consumer And this is where we think there's going to be some issue, especially when people go to drive and realize that it costs so much, and maybe that vacation that was 6 hours away looks a little long, and now the vacation is going to be 2 hours away. So again, these are things that we're going to continue to talk about and look at. But now it's time to shift gears a bit and look at Europe in the next segment.